My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is the man behind the Lords of Easy Money, Mr. Christopher Leonard. Christopher, introduce yourself to the audience. What's your background? How'd you get involved, interested in journalism, and what got you to write the book?
Hey, thank you for having me. I really appreciate it. So, quickly on background, I'm a reporter and a journalist. I am not like an investment advisor or anything like that. Nothing I say is investment advice. So whatever. I've loved writing since I was a kid. I got into journalism at the Missouri School of Journalism, got into reporting on businesses, and I think so. I write books and magazine articles, and my core interest is just writing about really big institutions. I wrote a book about Tyson Foods, the biggest meat company, Koch Industries, the second largest privately held company. And it was actually while I was reporting the book on Koch that I got into the Fed because I was interviewing this guy who was really, really brilliant investor. And this was back in 2016. And he started explaining to me what he was seeing in asset markets and then explaining what the Federal Reserve was doing. And he explained it to me in these concrete terms about how the Fed was creating new money inside the Wall Street bank accounts, how the Fed had basically created 3.5 times the level of new money in about 4.5 years between '08 and 14. It had created 3.5 times as much money as it had created in the first century of its existence, and how this was pumping up asset values in corporate bonds, stocks, tech stocks, real estate. And it just blew my mind. And I'm like, this is a super important story. Really important to understand what's going on in the economy and financial markets. And that's how I got into it. I just got super obsessed with the Fed and with particularly the decade of Fed policy in the 2010s. And, I've been doing it ever since, honestly. And that's how the book came about.
So you said 2016, as I heard you. Presumably you've heard the term quantitative easing over the years, but it sounds like you didn't realize sort of maybe how consequential quantitative easing might have been until you really took a deep dive in terms of Fed policy. I've heard some of your prior speeches on this. Talk about the importance of 2010 and how what the Fed did back then was really the start of what I think you and I would both agree on is a very distorted economy.
Totally. And, the subtitle of my book is How the Fed Broke the American Economy. And that's not how this started in my mind. I just, I originally thought of this book as like how quantitative easing changed the world, but it was really through reporting this that I frankly just kind of got more and more disillusioned with the leadership of the Fed and frankly kind of alarmed about what they're doing. But okay, 2010, you're correct to focus in on that because that was really a huge change. I mean, the book opens on November 2nd, 2010, when the Tea Party wins the midterm elections, and we kind of get this feeling this is post-financial crisis. Like our fiscal authorities, our democratically elected authorities, are not going to be moving much and doing big action in economic affairs anymore after the Tea Party takes over in 2010. Okay. But that was all happening against this backdrop of our central bank, the Federal Reserve, becoming more and more important or taking a larger and larger role in our economic affairs. And we can talk about all that, like the Greenspan era, the Maestro era, how important the Fed came, how its footprint kept expanding. But that was really exacerbated or intensified during the financial crisis of 2008, when the Fed just does, 5 alarm fire emergency action, doubles the size of its balance sheet, really breaks out of historical norms, and stops, what could have been like Great Depression 2.0 in '08. But in 2010, this is a real step change in what the Fed is doing, and really interesting because when the Tea Party takes over and all that stuff's going on, the American economy is out of the 5 alarm fire phase of the global financial crisis. Okay, things are bad in 2010. Unemployment's like above 9.5%. Economic growth is weak. This is what life is like in the wake of a financial or debt crisis or credit event. But nobody inside the Fed thought we were heading into a recession. I mean, that's clear from looking at the transcripts of their internal debates. They did not think we're heading into a recession. Instead, what Ben Bernanke does on November 3rd, 2010, is he says, okay, look, we're going to do a jobs program. We're going to push ourselves into the middle of economic development in America. And we're not going to just like manage the currency or be there for bank bailouts. We're going to actively pump money into Wall Street through a truly experimental program called quantitative easing to try to create jobs. And that's when we were really off to the races with a new era of very, very, very aggressive, widely affecting like monetary policy, super interventionist. And so it really all started in 2010 with that second round of quantitative easing.
And why is it that Bernanke felt the need to to go to that level? I mean, was there fiscal pressure? Were there other influences that pushed him to do that?
Huh. I mean, this is a big question. So, Bernanke is super famous for being an expert and student of the Great Depression. And one of the big lessons of the Great Depression was the central bank kept monetary conditions too tight. And that prolonged the crisis and led to, the second downturn, I think it was in 33 or 34. And so his whole mindset is we're not going to repeat that mistake, which of course, like, makes sense. But inside the Fed in 2010, there was a lot of opposition to his idea. And I mean, let me back this up again. I was like, why is he doing this? Here we are. This is November 2010, and I've kind of described the condition. Things were weak and bad because we had this profound hangover from the debt crisis. But we were not heading into a recession. And I think Bernanke's view is like there's a danger to just limping along. If we just keep limping along, it could lead to a negative outcome. And I mean, he writes about this a lot in his memoirs, but there's this other group inside the Fed leadership, inside the FOMC. I focus on the one guy who voted against this, but there was profound debate, real profound debate inside with these people saying, if you do this quantitative easing, if you do this sort of very interventionist money printing program that we've never done before, yeah, you might create some jobs. You might bring down the unemployment rate by a very small degree, but you're going to be building up long-term risks because this can stoke asset bubbles. And furthermore, not only is it going to stoke asset bubbles, but once you start doing this, you're not going to be able to stop. It's going to become a quagmire. But Bernanke's push was like, I hear you. There are risks, but there's also risks to just letting the economy limp along, and we're going to get caught trying. I'd rather take the risk of radical intervention than restraint or sitting by. That's how I would characterize it.
And presumably that's just because of the math of the lower bound of 0%. So I've put out that clip of Bernanke in 2009 doing the 60 Minutes interview where he was asked that question about, people are afraid that all this is going to create inflation. This is coming out of the great financial crisis. And he was asked the question, how confident are you in your ability to control this? And his answer was 100%. We can raise rates in 15 minutes if we have to. So presumably that zero bound is what freaked him out.
Well, what a great point to bring up. We were at the so-called zero bound, which is when, the Fed's main, before this era, the Fed's mechanism to affect the economy was the short-term interest rate, the overnight bank loan rate, the Fed funds rate, and that was at zero, pedal to the metal. That's where this whole thing started. And you can't go lower than zero, rather, with interest rates. I mean, some people messed with negative interest rates. That's kind of a side issue. The Fed wasn't going to do it. And so, yes, Bernanke's whole thing was, how do we stimulate more growth when rates are already at zero? And I've really got to point out, I can't overstate this enough. There was intense debate of people saying, we hit zero. We lowered rates to zero during the financial crisis, but here we are like a year later. We've got to start slowly normalizing rates. And we're talking like raising them to 0.25, maybe 0.5, because historically, the Fed funds rate was between 3 and 6%. Zero is intense. Zero is radical. And FYI, like the Fed kept the rate at zero for 7 years between '08 and the very end of 2015. 7 years of 0% interest, totally unprecedented, totally radical. And you're right. Ben Bernanke was like, wow, we're at zero. How do we go below zero? The first chapter of my book, the title is Below Zero. And the answer is you print money in the banking system through this thing called quantitative easing, which we can discuss the mechanics of. But the short headline is you're printing money inside the banking system in hopes it'll stimulate investment. And I've got to circle back and say Bernanke's faith that they could raise rates in 15 minutes was misplaced. It turned out that wasn't true. Sure, they can raise rates. They tried to raise rates in 2018 and 2019, and the system short circuited when they hit the number of 2.5%. And they got back to zero again. COVID happened, kind of unrelated. When they raise rates again, it creates massive, 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 like third order consequences. So it's totally not accurate to say, hey, if we see inflation again, no problem. Tools in the toolbox, rate hikes, we got this. That is misplaced confidence.
How much do you think Japan's trajectory factored into Bernanke's own push here? Right. I mean, sample size of one, but that's the example that people always reference. I mean, if I'm in Bernanke's shoes, sure, all this is with the benefit of hindsight. I'd probably say to myself, we got to get out of the idea of 0% forever. So let's go as aggressive as quickly to jumpstart things so that we're off of zero. Sort of do more to try to shorten the duration. Do you think there's an element of some kind of comparison there in Bernanke's mind to Japan?
Well, here's how I see it. And first of all, the theory that we're going to jumpstart this thing to get off zero, I don't think it was the plan. But if it was, it didn't work. We were at zero again for 7 years. We were basically at zero again until 2022. And the money printing did become a quagmire that we couldn't get out of. And Mike, can you still hear me? I heard a little weird beep.
Yeah, good. Because I brought up a additional speaker. Yeah.
Okay, cool. Sorry, I'm not the first time. Okay, so Japan is so interesting. They got into like that so-called liquidity trap or whatever. They had their own asset bubble that exploded. They've had super low rates for years, critically coupled with really weak productivity growth and weak economic growth. Bernanke, here's how I see it. Going back, and I feel like Japan literally was kind of the petri dish to test out these things. Bernanke wrote this paper. It's cited in the book. I think it was in 2000, where he was giving advice to the Japanese central bank, where he was saying, "Go below zero. Do this interesting, exotic, bizarre technique called quantitative easing to print more money." And so it was sort of like the test lab. He was advocating in the early 2000s for even lower, I would call them more aggressively easy money policies in Japan. And the fact that like Japan was caught up in a morass for a decade didn't seem to like cause any hesitation. I don't know. It doesn't seem to me like a good poster child for easy money policies because the growth has been so weak, and it's pretty like widely recognized that it hasn't worked out well for them. But literally, we borrowed a lot of these ideas from what we recommended to Japan, and we started doing it in 2010.
Where were the politicians throughout this? I mean, okay, so yes, the party line is the Fed is separate from the government, from the federal side. We know that's not really fully true. I mean, totally. I remember I've referenced this example before, but when Greenspan was doing his book tour for The Age of Turbulence, he was being interviewed by some anchor, and he said, "In all my years as Fed chair, never did I have a single politician ask me to raise rates." Right, so right, which makes sense, right? I mean, you get voted in based on nominal, not based on real. I mean, that's just the reality, right? So my point is, during that time, just take us back in time. Were there any concerns being expressed by federal officials? Was there sort of a like a nod to say go ahead and do it because you're basically then buying up our debt, which might result in a desire to have more debt, more loans for certain social programs? How was the interaction back then?
Okay, I love this question and could talk about this for an hour, and I won't. It's such a critically important question, and you just mentioned this one aspect of the Fed's policies enabling cheap debt. Super important. If I could put that to the side for 1 second, let's talk about 2010 when the Fed goes down this experimental, unprecedented path. There really is no other way to describe QE. I mean, what were the politicians doing? They were fighting with each other on cable television every night. Um, QE,
Something's never changed, by the way. Some things never change.
well, that's not fair. They get worse. They do change, they get worse. um, so, yeah, sorry. Like the politicians were engaged in this ultra heated blood sport over, I mean, I don't want to like demean it, but like serious issues. The Affordable Care Act or Obamacare was a serious piece of legislation that had super far reaching effects. And, you had people showing up to town hall meetings, and it was very, very, very intense. Cable news, I think, intensifies the red team versus blue team personality fight. And that's what's going on every night. And I actually spent a lot of time looking at this. When QE happens, there's there is I there is intense debate inside the top committee at the Fed. This was not an easy thing. Kevin Warsh, a former governor, by the way, vehemently opposed this thing and articulately opposed it for the risks it would build up. And Ben Bernanke like openly talks about kind of lobbying Kevin Warsh and cutting deals with him and getting Kevin to finally vote for it. But what I'm trying to say is this was hotly debated, but that debate never really penetrates the political world or the kind of media world. When it happens, right-wing media tended to pick up on it a lot more because I think there's this sort of more inbuilt skepticism of central bank in conservative circles. Left-wing media seemed to me to just not pick up on this thing at all. And so it did not penetrate. I feel very comfortable saying this issue didn't penetrate broadly in political circles. Now, I interviewed a former governor of the Fed named Betsy Duke. She's a former Wells Fargo, I think, vice president who was a governor for many years. And she put it so well. She's like, politicians love the Fed because we create new money out of thin air without taxing anybody. They see it as like free money. And so the Fed starts doing this policy that's pretty super interventionist and aggressive. And the politicians can kind of just let that machine go without even addressing it. Because, frankly, what I would describe as the harms, they're not immediate. They're more long-term. They're more subtle. Like, for example, dramatically widening the wealth gap, creating asset bubbles, financial instability. That's kind of happening like behind the curtain. And in the main venue of the political debates, they just didn't talk about it. And it's much easier to just kind of let this thing go. Does that make sense? And if I could, please, I don't mean to like over talk or whatever, but when the Fed executes quantitative easing, it does it by purchasing assets, which to get down to it, it's purchasing US debt, treasury bills, some mortgage bonds, but mostly treasury bills. And so what the Fed is doing is effectively making it cheaper for the government to borrow money because it's a huge buyer of the government's debt. And it's very interesting, like, as each year goes by, the Fed becomes a larger and larger purchaser of US government debt, so that by like 2021, 2022, some months, 80% of all US government debt is getting purchased by the Fed, which is like, wow. So what they're doing is creating a big permanent buyer for US debt and making it cheaper to borrow. What politician is going to argue with that? But and dude, I'm sorry, I just like, then that raises a real issue of independence now, where we stand right here today in 2023. It's not like Joe Biden is going to pull Powell into his office and say, like, you cut rates right now. But Powell's facing this decision of like, dang, if I hike rates, it's going to make US government debt so much more expensive and bring so much heat on this central bank that I don't know if we can really do that. So that's a totally different type of Fed independence that I don't see talked enough about. Okay, sorry.
Yeah, no, no, I'm with you. And actually, I've some people will argue that I'm being conspiratorial in this, but it is a strange coincidence to me that Brown University had an estimate on how much the cost of the Iraq War was, and by their estimate, aside from the lives lost, it's around $8 trillion, which is about the Fed's balance sheet.
Wow.
So, to your, you can argue that that's not exactly a direct link, but it's oddly coincidental that the numbers are fairly close to each other. So, that point is valid. QE also financed, the military, and kept us. You can argue maybe at war longer than maybe we should have been, if at all.
You know, it's so interesting. The C word, conspiracy, right? Like, of course, there's zero evidence, but like that who would it have been? Bernanke sat down or Greenspan sat down with Bush and said, "Okay, we'll fund your war." Okay, no secret meeting in a secret society, but just look big picture at incentives of the U.S. government is funding more and more of its budget through borrowed money, and the Fed can buy that and keep it cheaper. You know, sometimes you don't have to have a backroom meeting for things like this to kind of push forward in a way that you turn around and by 2019, the U.S. is funding, and this is pre-COVID, like the U.S. is funding its budget through $1 trillion in borrowing every year during the good times, and the Fed is purchasing Treasury bills and keeping those prices lower. Yeah, that's kind of how I would put it.
Just for the remaining 30 minutes here, everybody please make sure you follow Christopher Leonard and check out his various books, Lords of Easy Money, Copeland, and The Meat Racket. By the way, I would think, which we should talk about a little bit towards the end, that the commonality across those books probably is a story as old as time, which is that as an organization, whether it's private or public, gets bigger and takes on more responsibility, becomes more inefficient, causes it to be not what the original intent was, and then results in unintended consequences. Just more of a side note, I would think.
Okay, I can only give you what I've come to through reporting this, and the way I see it, taking the clock back to like 2011, 2012, I feel like the Fed was driven too much by short-term incentives, by trying to pump up economic growth in the short term and ignoring long-term risks. And the more they did it, the deeper they became trapped in the policy. So they do the first round of QE in 2010. By 2012, and I'm going to get to your question for sure. I just like as background, like by 2012, they're like, well, this wasn't working that well. Let's do it like 3 times as much now. Okay. And so they get deeper in. And then by 2018, they find themselves at the point where if they try to pull back this very intense intervention, they're going to create a crisis, just straight up create a crisis. The system short circuited in 2019 prior to COVID. And it showed how deeply enmeshed the Fed was. So inflation, price inflation is such an interesting thing. It's also different from asset inflation. The Fed was knowingly creating massive asset inflation during the 2010s at like a double-digit level, year over year, in houses, corporate bonds, stocks, all the rest of it. And they're cool with that. But price inflation is the big scary thing that would force the Fed to tighten, which is where we are today. And the Fed, against its own expectations, didn't see intense measured price inflation during the 2010s. And we can talk a lot about that, why that happened. But I don't think they were trying to create price inflation. I feel like they were chasing a policy to boost economic growth that made all the big banks and private equity and hedge fund people happy. So, Blackstone wasn't complaining about this. And you can keep going down that road. And as long as price inflation never shows up, you can just keep going down that road. And then you get to the year 2021, and then, wow, price inflation comes with a vengeance, like really quickly from 4 to 9%. And that's how I've seen the situation, is that the Fed has been going kind of headlong down the road on this policy, never having the break of inflation. But your point of the very arguably like unpayable level of debt. I think that that's not like an irrational argument at all. And a lot of people I talk to are like, it's unpayable. And the Fed's only option and the US government's only option is to inflate the debt down and inflate it away. But this is what I'm saying. They're now, it's a quagmire. They're like caught in this tough position of having piled up and piled up and piled up all these consequences of the policy, that they're left with these really bad decisions. And you've got this enormous level of debt that was enabled by both the Fed and irresponsibility of fiscal authorities. Gotta restate, like, we were running $1 trillion annual deficits in 2019 during the good old days when like economy was growing. And so now we're at this point where we've got this massive debt, and if the Fed tries to raise rates, it makes that debt even more unsustainable. The interest payment line of the US budget is the fastest growing part of the budget, like right now. And really smart people are anticipating that the interest rate payments annually are going to be higher than the military budget within like a year. So that's pretty intense. And that's how I see the inflation question. Like, happy to go deeper on that if it's helpful.
By the way, those interest payments at that level, that sounds like a melt up in interest payments. But go ahead, Gary. Continue, and then I'll go to David.
And this is such a fundamental thing. This is not Donald Trump like bullying Jay Powell over Twitter. And it, you know, there's just this whole conversation about like, oh my God, is the Fed going to be independent? I mean, that's nothing. Like, who cares? The real test is going to be just what you were talking about. In December of 2023 or February of 2024, if interest rates really are still at 5%, because inflation is refusing to kind of get back in the pot with the lid on, and the US government is spending north of $1 trillion just on the interest and finding it more expensive to borrow. And all of a sudden, this entire fiscal system built on cheap debt is hindered. Is the Fed seriously going to be able to withstand the pressure? That's the question of independence in my mind. And if I could, the Elizabeth Warren stuff just fascinates me. And you know, I'm just retreating further and further into the world of print and can't really watch cable news at night anymore because like the whole conversation is just so bizarre. But there's this narrative that like the big evil Fed is going to hike rates to punish the American worker, and they need to be stopped. And like, look, I've written 3 books that advocate on behalf of the middle class American wage earner. I feel like I'm not some heartless right wing guy who feels like wages need to be depressed. But I'm looking right now at 2 books. One's called The Dying of Money by Genzo Parson, and the other's called When Money Dies by Adam Ferguson. They're both about hyperinflation in the Weimar Republic, which I know is like an outlier like thing that's not useful or whatever because of how intense that whole thing was. I got like 50 pages into both books and I had to put them down. Inflation is scary and it's bad for the middle class, and it gets out of control really, really quickly and becomes embedded and grows quickly. Like it's highly, highly worrying. So this idea that the Fed is trying to like punish the middle class by hiking rates. I mean, this thing is not going to be great if the Fed really does keep rates high. It's not great. And economic crashes always hurt poor and working class people. But inflation is also so destabilizing and so punishing to the middle class that I think there's a good case to be made that it needs to be, you know, combated, even if it's going to cause massive, massive negative side effects in markets, which, as you pointed out, really does trace back to these policies of the 2010s when the Fed was just breaking down all the guardrails, doing wild experiments in money printing, a fair way to put it, by the way, and when it was all kind of good and nobody was paying attention.
By the way, I would quickly say this is maybe a year ago. I think it was on Kitco. I was doing an interview, and I alluded to it in a much more dramatic way. But I said, we have to be really careful with all this talk around hyperinflation. The Weimar Republic created the conditions for there to be Hitler, right? And it wasn't me trying to argue that that's going to happen, obviously. But the point is that when you're in that kind of environment, history shows that bad actors really start to come to power.
And to me, and again, look, we could talk all day about how the Weimar Republic is totally different than our situation. There are huge, huge differences, what was going on in Germany back then. But your point to me is very well taken. It does give rise to bad actors, but the way I would put it is also it is highly socially destabilizing. It is bad. Out of control, embedded inflation is bad. It doesn't just make life harder for working people, it reduces faith in the system in this very important way. And it's just you don't let that pot boil over. And I mean, if somebody has this like strong argument for why they want to see heavy inflation, I'm all ears. But I understand the rationale of fighting it through rate hikes. Oh, such a big, big question. Fed credibility seems to me, and I wrote a book because it says how the Fed broke the American economy. So, like, take it. I mean, I've come to my conclusion of what I think about the policies of the last decade, but it seems clear to me that, particularly over the last year, the credibility has been profoundly damaged. Not okay. You're talking about funding fiscal debt and losing credibility in that way. But I also want to bring in missing inflation and the repeated statements that inflation was transitory. Big loss of credibility. And second, I mean, the so-called banking regulation is a big issue right now, like the oversight of institutions like Silicon Valley Bank. So I don't think that the Fed's credibility over the next year is going to increase. But your question is like, how could it regain credibility?
Well,
And
and to be
go
clear, Chris,
ahead.
sorry not to interrupt, but I think it's interesting, right? So I've used that line before. Inflation is not a monetary phenomenon; it's a leadership phenomenon, right? So is it the institution that's lost credibility, or is it the heads of the institution that are losing credibility?
I don't know that I would distinguish that because, like, the leadership culture of the Fed, I'll go ahead and say since Greenspan has been like really, really consistent in its approach and its theories. There hasn't been much deviation. And so, like, the leadership of the Fed, this committee of like 12 voting members on the FOMC, and then the Fed chairperson, I don't think is seen as different from the institution itself, which is unfortunate because, as I've said, like, we can't live without a central bank. You can't do a big economy without a central bank to manage the currency. It's vital. In my view, it's indispensable. You have a big school of thought of like, get rid of the Fed. I don't see how that works, from my humble opinion. But so I think that the leadership and the institution are pretty deeply intertwined, like from a public perception point of view. At this point, I mean, you talk back at me, but like when you ask me about Fed credibility, to me, right now, it's pretty totally focused around fighting price inflation. It's like, does the Fed, okay, you mentioned that the Bernanke quote earlier of like, hey, if we see inflation, we got the tools done overnight. Well, that's being really put to the test right now. Rates are still, frankly, relatively low compared to inflation. And yet we're seeing the system short circuit. It's March. A mega bank in the form of Credit Suisse has already gone under. Powell slowed down the rate hikes yesterday from 5 to 2.5. And the big question is like, are they going to actually fight inflation, or are they going to blink and cut rates again because the carnage in financial markets is so bad? I think among the like Wall Street financial types, that's the biggest test of credibility. But you're really driving a pretty huge question about broadly like the Fed and reform of the Fed in a way that builds credibility and trust with people. And like, you're just way past my pay grade on that. I don't know what that would look like. And my, as a reporter, I just got to say, like, by and large, the approach to the Fed is just to not think about it. It is not part of the political discussion very much. It's more so now, but for the last decade, it's not in the center ring. I'm telling you, it is barely discussed on cable news at night from the little bit of monitoring I do. And, and so I don't know. The push for reform isn't totally there yet, like broadly speaking.
But I think that's that's an interesting offshoot in terms of just the profession of being a journalist, being a reporter. I mean, uh, I don't recall really ever hearing of a journalist or reporter over the last decade really challenging whoever is the head of the Fed at that moment in time, saying, "Is this really needed? Are you creating unintended consequences?" Do you think there's an element of in quotes blame by that side of the community to not make the American people aware of the unintended consequences of Fed action?
Well, there are two levels to this. The first is there is a gigantic cauldron of blame that can be talked about, in my view, I'm sorry to say, but with just cable news in general. What they focus on, how they focus on it, the focus on personality, conflict, and superficiality is just not helpful at all for anything in our country, is my view. And policy discussions of just about anything, let alone monetary policy, can barely squeeze into that cage match. So I think that's bad. And then when you really then get specific about the Federal Reserve, I've said a lot. I feel like the institution is covered too much from the perspective of the financial community. Like there's so much obsession about how big is the interest rate change going to be at this meeting. That matters to bond traders, and kind of as a second order, it matters to all of us, because the health of the financial system. But I don't think that there's enough coverage about this thing in the way we cover even just like City Hall, let alone, the presidential administration, from a position of the public interest and with like respectful, the position of being a respectful adversary, of really questioning from the outside. I mean, I don't think we see enough of that. I just don't. And that's sort of where I come down on that.
I want to talk about incentives for a second. I tend to be a cynical person in general, which is why a lot of my tweets are framed the way that I framed them. But this point around how QE widened the wealth gap, maybe this is in poor taste to frame it in these terms, but I've seen some metrics that would suggest that Powell's worth like $40 million, and other Fed officials in the past are clearly very wealthy, which means they own assets. I don't know. Is there anything to the idea that this is somewhat self-serving because they themselves directly benefit as very wealthy asset holders to begin with?
Yeah, dude, of course. Like, I don't think that's rude at all. I mean, Jay Powell is frequently described in the media as a lawyer, which is like preposterous. I mean, he got a law degree, but then he did this sort of rotating career between big government and big finance, and spent a lot of his career in the private equity industry at Carlyle Group. And the disclosures I saw is that he was worth 50 million when he walked in the door at the Fed. Now, do I think this is like this really like clear cut, simplistic, grotesque thing where Powell's trying to boost his own retirement fund? No, but that's just not how the world works. And it's complicated. But the way I tried to put it is, these people who run the Fed belong to the investment and asset owning community, and those are the people they listen to. During the COVID crisis, Jay Powell's on the phone like 8 times a day with Larry Fink, the head of Blackstone, the huge, huge, huge hedge fund. And it's like the culture is the same, the incentives are the same, and the interests are the same. And so when you're hearing all day from hedge fund owners, and they're like, you've got to intervene right now or it's going to be ugly, you intervene. And then you're not hearing as much from, I mean, it sounds cliche, but it's just true. Like, then you're not hearing as much, for example, in 2011, from people who are like losing their homes, who don't have the concentrated interest groups or the phone line to Jay Powell. And so to me, it's this much bigger picture of, the incentives of the people running this thing and the way they see the world, if that makes sense. And again, doing things like quantitative easing in terms of public perception, it's like pushing against an open door. You print all this money, you pump up the stock market. You know who's not going to complain are like the richest, most powerful people in Washington and the largest banks in the world. They're not going to complain. They're going to complain when, their asset prices start to go under, and then you got to bail them out. But that's kind of how I see it. It's just sort of more an alignment of interests. Oh boy, you're giving me 3 minutes to answer that question. Like, I'm
You know how
kidding,
the
but
media works, Chris. You gotta solve the world's problems in a matter of a couple of minutes here.
okay. So I'm sorry to sound like this. The interests of the very richest 1% and the big banks have consistently been met. Like I write about the COVID crash, the speed out, the bailout for the asset owners, the hedge funds, and the private equity firms. It was like a Japanese speed train, perfectly oiled, perfectly running. The bailout for like the sandwich shop owner through the PPP Act was like money going through a leaky pipe system. It just didn't work at all. That's just like how how the system is built. Your question about fantasy land, and I think this is the note I'd like to leave on, is like you got these two spheres of people, Wall Street and then the PhD economists who run the Fed. The Wall Street people, self-admittedly like driven by greed to make money, totally unsentimental about what's going on. They know what's up. They know this thing is a house of cards. They're going to make money off it till it collapses, and then probably they'll get bailed out. The PhD economist types and the Fed speak types who seem to run this institution, I'm sorry to say, like it's glib, but there's a lot of fantasy land going on there. They're driven by abstract models, high theory, and not much interest in how this stuff kind of plays out in the real world once it goes through the plumbing. And they just keep pursuing these policies that have now left them trapped in a pretty unenviable situation that will probably spill over into a lot of economic problems for the rest of us. So not a happy note, but that's why I wrote the book. I really think that this is just hugely, hugely consequential policy that we should all be paying attention to, whether you agree with like my assessment of it or not.
Yeah, no, I think that's a good place to wrap this Twitter space up. Again, everybody, please make sure you follow Christopher Leonard. Check out The Lords of Easy Money. It's available on all your favorite bookstores, Amazon, all that good stuff. Chris, really enjoyed listening to you. I had on my list to talk to you about to hear your thoughts on Thomas Honig, who was, I think, the real Cassandra in the story. But maybe we'll save that for another space at some point.
Sounds great. Thank you for having me. I appreciate it.
Yeah, no, thank you very much for joining, and I will see you hopefully all on the next space or spaces. I think I have like 6 tomorrow as I'm catching up on content. Thank you, Chris. Appreciate it.
Thank you. Bye-bye.
Cheers.